Hi, this is Seth David from the world-famous Nerd Enterprises Incorporated, bringing to you another special screencast. This time we're talking about QuickBooks tips on tax planning for your 2011 taxes. Knowledge is power. Make an impact by learning more. Call me right now at 866-945-8070 for information about private trainings. We record the live session with you so you can review it as often as you like afterwards. Hi. So the reason this is important to involve the owner in this process, the reason that it is important to involve the business owner in this process, is because we're reviewing the accounting of the books, but we're doing something that really requires insights that only the owner of the business would have. And the idea here is to go through pretty much each account in the books and take a quick look at what's in there, or for that matter, just we're performing some kind of a test here to make sure that we feel that the number is accurate and that it's classified correctly. So let's look at the balance sheet first. The balance sheet becomes our checklist, and the first thing you want to do with these balance sheet accounts is make sure they're reconciled. Just click Banking and Reconcile here, and make sure that there's a reconcile date in here that's as recent as the last month that's ended. And that's really how you double check the bank accounts. The accounts receivable, you're going to run accounts receivable reports. There's a ton of them in here. Start off with the AR aging summary and make sure that everything you see in there looks accurate and reasonable. Make sure that there's nothing really old. If it is old, make sure you understand why it's there and not being written off. Or make that determination that something needs to be written off as bad debt and write it off. Inventory is pretty simple and straightforward as far as how to check it. You count it. You take inventory, you count up your items, and you adjust QuickBooks accordingly. So that's kind of a no-brainer there. Your prepaid inventory, you want to make sure that this has been amortized properly every month. So here's a prepayment. I double-click it, and I look in here, and I see what's in here. Here's a prepayment that was made in January, and here I'm taking the amortization. Here's a different policy, right? So here I have the auto policy. And so I come in here, and here's an example of why it would be a good idea to include the name on these journal entries. Because, for example, what I might want to do is total this by payee. Problem is now it's all through my insurance company. And what that does is it puts the insurance, this actually might be useful anyway, but it puts the insurance premiums or the prepayments here, and it looks like I'm only amortizing one thing here monthly. So the question is, where's the monthly amortization for the other two policies? And what I mean by that, let's go back to a total only view. Here's the 6875. Clearly 1878.13 is meant to be the amortization of this insurance premium. Where's the amortization of this one? Where's the amortization of this one? These are the questions I'd be asking. So prepaid, you double click these accounts and you look in to see what's inside them in order to determine if they're accurate. You look at something like the undeposited funds, and we'll go to banking and we'll go to make deposits, and let's see, is there anything really old in here that needs to be addressed? That's a pretty simple one, right? Fixed assets you want to compare to your last filed tax return and make sure that it agrees, because most likely unless you're doing depreciation adjustments every month, then the last filed tax return should have balances that equal your fixed asset accounts here. Those never change, and of course the accumulated depreciation should agree. Accounts payable, you're going to review the same way as receivables. Just go to your payables reports and your vendors and payables, run the aging summary, and make sure there's nothing really old in there. And if there is, ask yourself why it hasn't been paid. And at the same time, look at even the current stuff and decide if you see something in there that you know. Then here's where the business owner comes in. The business owner is going to know if he sees something in there that he knows had to have been paid by now. I've encountered this so many times in my experience that's why I've learned that I have to bring in the business owner to this process, because the business owner can look at my payables list and say, hey, I know I paid those guys. Why is it showing up here as a payable? And what usually that indicates is that we entered the bill and then somebody wrote the check and just recorded it directly to an expense account instead of paying the bill, which means we've now doubled our expenses and understated our profits. So very, very important to do that review and bring the business owner in. Credit cards need to be reconciled the same way as the bank accounts. Your payroll liability should zero out. If not, just confirm that it's because the check hasn't been written or recorded yet to pay these taxes into the government. Line of credit also should be reconciled. We want to make sure that this really is the balance that the bank would agree is what was owed as of the date of this balance sheet. And for that matter, we want to make sure that our interest expense is accurate, because that ties directly into the line of credit, the debt that we have. Finally, the equity account. This comes up a lot with the business owners. Well, almost always they tell me, oh, I know I didn't take that much out. So you just run this report and double-click it for them and show them all the checks that make this balance up. And if need be, you can pull a bank statement and confirm that a check cleared and see who it's paid to. So that will alleviate any skepticism the owner might have. Once you've reviewed the balance sheet, you're going to do the income statement, the profit and loss statement in really the same manner. You're going to come through here and you're going to look at my income. You can double click the total income. This doesn't really give you a whole lot of meaningful information, but if you total it by customer, now it starts to, because I can confirm, did I do this much business with these customers? And when I show it to a business owner by customer, that's usually how their thinking works anyways. I know for my own business, if I look at a number, and that number is supposed to represent how much money I earn from a particular customer, I know if it looks about right. You know, I may not know the exact number, but it'll certainly stand out to me if it's way off. And that's the idea here, is to give it a reasonableness test and ask yourself, does this look about right? And if it doesn't, investigate further. Find out why, or just confirm that it is right. Usually what will happen is one of two things. Either we find a problem and we fix it, or there's kind of an aha moment where the business owner looks and says, oh yeah, that's right. Now I remember. You know, it's one of those kinds of things. Cost of goods sold, when you take your inventory and you confirm that your invoicing was accurate, you're pretty much taking care of cost of goods sold. Because as you'll see if I double click this, it comes from the invoices. Right? I post an invoice and I sell an inventory part, it books the related cost of goods sold. Materials, you know, same thing. All this stuff. But again, in the next video, we're going to do the analytics. We're going to look at this stuff on a percentage basis. This is where we can spend a little more time confirming that cost of goods sold looks right, because we'll look at gross profit, for example, in terms of percentage, and see if that looks about accurate. If it doesn't, and if it doesn't when we compare it to a prior year, then we know our cost of goods sold might be off. Expense accounts you're going to look at kind of in the same way that I've shown you already. You're going to double click each one. If there's just a few transactions, you can very quickly see at a glance whether or not it looks right. Otherwise, what you can do is total by payee. So let's take dues and subscriptions, for example, here. And if I total this by payee, now I can see very clearly if these are people that really belong in dues and subscriptions. For that matter, and again, here's where the business owner comes in, they might have a reason why this particular professional association they want shown separately. There's a reason, and a lot of this, the reason is it's nothing to do with what's right or wrong. It's got to do with how I want to report on this information and how I want it to show up on my P&L so I can analyze it properly. So that's how you review the expense accounts. You just double click them, and again, if necessary, total it by payee so you can see very clearly what's in there and confirm that it belongs. Here's the accounting fees. Payee, I have the accounting firm, and I have, you know, online accounting. If I had my service fees or something for my QuickBooks Online edition, something like that. Or here it looks like quarterly checkup. Again, you're just looking at this to make sure that it makes sense. And that's really what it comes down to, is you want to make sure that it makes sense. And that's it. I can double click my payroll, make sure that Jonathan Graham really is the office manager, that he really does belong, you know, as an office manager salary. Maybe I find out that, oh no, this is the owner and it should be officers' salaries. You know, these are the kinds of things that you would never know if you didn't take the extra step to double click the number and see what's in there. The interest expense, as I mentioned earlier, is something I expected to see because I saw the line of credit. But now I want to take a look and make sure. I've looked into interest expense accounts and found that entire liabilities have been left off the books and the interest overstated because all of the payments were being booked to interest expense. And you know, a lot of times the clients just don't know this because they don't have the accounting background. They don't understand that when there's a loan, there's a liability that needs to go on the balance sheet. The interest is the cost. That's what goes on the profit and loss. That's what it cost me to borrow the money. But the money I borrowed is not when I repay it, that's not an expense. It's just I'm repaying a loan. So that's important. The other thing I notice when I look here is, doesn't it kind of look very quickly at a glance like something's a little wrong here? Why am I seeing the same amounts twice every single month, consistently? Same amounts showing up twice. It looks like they were trying to, and I'm not sure if QuickBooks, when they made the sample company file, did this on purpose to give us an exercise on something like this, on, you know, purposely to, you know, have a mistake in there that we could find. But it's definitely a mistake. I looked into this off recording, and here's what happens. I have several methods of tracking different types of loans, which you can look at videos I have got on my blog, nerdenterprises.com/blog, and you'll see in my drop down there's a category for loans under transactions under QuickBooks. And you'll see there's different types of loans and different ways that you can track them. One of the cleanest ways, in my opinion, is to actually journal the interest on each month. So you're debiting the expense and crediting the liability. By crediting the liability, you're actually adding the interest to the amount that you owe on that loan. But when you do it that way, it's nice and clean because all the activity gets run through the liability account. So I can do a report on that liability account and I can see the interest coming in. And then most importantly, I can see the payments coming in to pay off that liability. The problem here is it looks like we journaled the interest on, right? Here's a journal entry. posted January 31 with $100.13, increasing my line of credit. It's a credit to a liability, is an increase to a line of credit, and increasing the expense, debits increase expenses. So that's perfect. I've accounted for the interest expense, and I've accounted for it by putting it in as an addition to the liability. When I do it this way, the payment has to go entirely through the liability, and that's what's not happening here. Here's the check, written February 5th, also booked to interest expense, consequently doubling the interest for the month. Let's go take a look at the liability account, and what I would expect to see now is, that the entire liability is probably still on the books without any proper reduction based on payments. Or if it is, yeah, see here the interest is coming in. Remember, this is a credit. Notice the balance. It's increasing the amount owed. Now a transfer here, we're debiting, they actually just paid it off. That's something else. But these are all amounts adding to the loan. The payments aren't coming in to reduce the loan. We're making big lump sum payments, but the point is when I write the check to record the interest, if I put the interest on here, then if they're writing checks separately just to pay the interest, those need to go against the liability, because when I recorded the interest, it went into the liability. So this is a problem, and it needs to be corrected. All those checks need to be changed to go through the liability account. And this is exactly the kind of thing you're looking for when you're reviewing a set of books like this at year-end for tax purposes. Now imagine if your tax professional had to spend the time doing this, then you'd be paying them for something you could easily catch and fix yourself. And this way, again, they can spend their time focusing on tax strategies and tax planning for you so that you're getting the most out of the money you're spending with them. Let them do what they're paid for. The problem that I know a lot of tax professionals have, because I talk to them almost every day, is that they're spending a lot of their time doing bookkeeping. They don't want to be doing the bookkeeping. They would much rather you do your bookkeeping so that they can focus on what you really paid them to do. But the problem is they can't do what they were paid to do until they know that the bookkeeping is accurate and it's precise, right? I can't have my interest doubled like this. It's a problem. My tax return wouldn't be accurate, and you would, well, in this case, you'd underpay your taxes. Some people might like that, but you're underpaying them for the wrong reasons, and it could come back to bite you later. So not really the way you want to do things. Anyway, as always, if you have any questions, please post your comments down below. Let me know what you want more of, what you want less of. Post your comments. Email me, Seth@nerdenterprises.com, and let me know if there's anything in particular you'd like to see me do in the form of a screencast. I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web. Hi, this is Seth David from the world-famous Nerd Enterprises Incorporated, bringing to you another special screencast. This time we're talking about QuickBooks tips on tax planning for your 2011 taxes. Knowledge is power. Make an impact by learning more. Call me right now at 866-945-8070 for information about private trainings. We record the live session with you so you can review it as often as you like afterwards.